Welcome back. This is Accounting 101, and we're going to cover Chapter 10, Liabilities. Learning objectives for this chapter is to explain how to account for current liabilities, describe the major characteristics of bonds, explain how to account for bond transactions, explain how to account for long-term notes payable, and finally discuss how liabilities are reported and analyzed. What is a current liability? This should be a review because we talked about this in a previous chapter. But it's debt that a company expects to pay from existing current assets or through creation of other current liabilities within 1 year or the operating cycle, whichever is longer. Current liabilities include notes payable, accounts payable, unearned revenues, accrued liabilities such as taxes payable, salaries and wages payable, and interest payable. And when we look at the 1 year, the operating cycle, to determine if it's a current liability, it should be the same measurement we use on the current assets to determine if there's a current asset or not. Quick review question. To be classified as a current liability, a debt must be expected to be paid within 1 year, the operating cycle, 2 years, or A or B, whichever is longer. And the answer is D, 1 year or the operating cycle, whichever is longer. Notes payable. This is a written promissory note, frequently used to meet short-term financing needs, usually require the borrower to pay interest, and issued for varying periods. This is the same type of note that we talked about in Chapter 8 when we talked about receivables and notes receivables. This is now the other side of it, where we have the liability, we are paying the note off, so it's a liability to us. So First National Bank agrees to lend $100,000 on September 1st, 2027 if Cole Williams signs a $100,000 6% 4-month note maturing on January 1st. So we need to prepare the entry on September 1st, prepare the adjusting entry on December 31st, assuming monthly adjusting entries have not been made, and then finally prepare the entry required on January 1st, 2028, the maturity date. So let's look at what we do on September 1st, the date that the note is issued. We're going to debit cash $100,000, credit notes payable $100,000. So we're the borrower, we're Cole Williams Company. We signed the note. We said we want $100,000 today. We're going to pay that back in 4 months plus 6% interest. Okay, so we recognize that liability. Now we have the cash in our account as well. Next, prepare the adjusting entry on December 31st. The adjusting entry is to recognize the interest expense. So in this case, it's $2,000. We're going to debit interest expense, credit interest payable. Okay. How did we calculate the $2,000? It's the same formula we used when calculating interest when we were looking at notes receivable. It's the face value of the note times the annual interest rate times in terms of 1 year. So in this case, $100,000 face value, 6% annual interest rate, 4/12, it's 4 months, and that equals $2,000. And finally, for this example, we're going to prepare the entry at maturity. We're going to pay off the notes payable and pay the interest. So the cash that we're going to pay out is $102,000. So we're going to credit cash $102,000. We're going to debit notes payable to relieve that liability and debit interest payable $2,000 because we're relieving that interest payable liability as well. Okay. If you think back to Chapter 8, when we did notes receivable, it was just the opposite. We had the notes receivable that we were crediting, the interest receivable, and we were receiving cash because we were receiving the cash. We loaned the money and now we're getting the cash back. Now we're looking at the other side of it, the notes payable. We're the company that borrowed the money in the first place. We had that liability of notes payable, and we're paying that off at this point. Notes payable is always going to be recorded at the face value. That's why we use that different liability account, interest payable. So we keep that notes payable at the face value, and the interest that we accrue goes into the interest payable. Let's look at sales tax payable, another liability. Sales taxes are expressed as a stated percentage on the sales price. The selling company, the retailer, collects tax from the customer when the sale occurs. It enters tax separately in the cash register, or it includes it in the total receipts, and then remits the collections, usually monthly, to the state's Department of Revenue. So if I'm a retailer, I have to set the price of the item I'm selling. When the person buys that, I collect the amount that I'm selling that item for, plus sales tax. I can either just look at the total and include that in the total receipts, or I can separately calculate what the sales tax is and record those separately in the cash register. So if we're going to look at examples where companies do not enter sales taxes separately, they're just going to show the total receipts. So Cooley Grocery enters total receipts of $10,600. Tax percentage is 6% of sales. To figure out how much is sales revenue and how much is sales tax payable, we have to do a calculation where we take the total receipts, the 10,600 in this case, divided by 1 plus the tax rate, so 1.06. That gives us our sales revenue, $10,000. And then to calculate sales taxes, we subtract the $10,000 from the total receipts, so the 10,600 total less sales revenue of 10,000 is 600, and that's a sales tax. Okay, so kind of working backwards. If you were to record it separately, you would record sales revenue of 10,000, 6% sales tax, so 6% times 10,000 is 600, and that would be your sales tax amount. So that's the other way to do it as well. The March 25th cash register reading for Cooley Grocery shows sales of $10,000 and sales tax of $600. The journal entry that we're going to record, debit cash $10,600. That's the amount of cash we received. Sales revenue, we're going to credit $10,000. That's the value that we sold, the items that we sold to our customers. We had sales prices of $10,000 on that. And then we record the liability, sales tax payable of $600. So we've collected that money, but we don't recognize revenue on that money because it's just a pass-through where we collect it from the customer and then submit it to the state or the local government, whoever is imposing that sales tax. Unearned revenues. We talked about this a little bit before, but when you think about current liabilities, unearned revenues can be a big current liability depending on the type of business you have. So remember, this is advance payments that are received before a company delivers goods or provides services. So when a company receives the advance payment, a performance obligation is created. When the company satisfies that performance obligation, it recognizes the revenue. Okay, so some examples of this are airline. Unearned ticket revenue is the liability. When they take the flight and the passenger is on that flight, they can recognize the ticket revenue then. Magazine publisher. If you subscribe to a magazine, a lot of times you pay in advance for a year, 6 months, something like that. That magazine publisher is going to have unearned subscription revenue because they're collecting the cash first as they publish and send the magazines to the subscribers. they can then recognize the subscription revenue for that uh, particular issue of the magazine. And then hotels, sometimes you prepay for a hotel room before you stay there. The hotel will have that as unearned rent revenue once you stay there, and they can recognize the revenue then, in this case, rent revenue. So let's look at some journal entries. Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. What is the entry for the sale of the season tickets? It's cash of $500,000. It's 10,000 season football tickets at $50 each. So that's where the 500,000 comes from. And we're going to credit the liability unearned ticket revenue for the $500,000. As each game is completed, Superior records the recognition of revenue with the following entry. So we played a game on September 7th. We're going to debit unearned ticket revenue for $100,000 and credit ticket revenue for $100,000. How did we get the $100,000? We had $500,000 of total in our unearned revenue. That's for 5 games. So for one game, it's the 500,000 divided by 5, gives us the amount for one game. It's $100,000. So each game we can recognize $100,000 of revenue and reduce our liability in our unearned ticket revenue account. Another current liabilities is current maturities of long-term debt. This is the portion of long-term debt that comes due in a current year. There's no adjusting entry required. It's just recognizing that you have it and then showing it on your financial statements how much is current. So Wendy Construction issues 5-year interest-bearing $25,000 note on January 1st. This note specifies that each January, starting January 1st, 2028, Wendy should pay $5,000 of the note. When the company prepares its financial statements on December 31st, 2027, what amount should be reported as a current liability? $5,000, because that's what's going to be paid in the next year. So between December 31st, 2027 and December 31st, 2028, in that year, they're going to pay the $5,000. So that's going to be shown on the financial statements as a current liability. And then what amount should be shown as a long-term liability? That's going to be the $20,000, which is the $25,000 note, minus the $5,000 that you're showing as the current liability. So you and several classmates are studying for the next accounting exam. They ask you to answer the following questions. If cash is borrowed on a $5,000 6-month 6% note on September 1st, how much interest expense would be incurred by December 31st? So we take face value, $50,000, times 6%, the stated interest rate, the annual interest rate, times time. So it's 4 months out of the year. Even though it's a 6-month note, at December 31st, only 4 months have passed. So we take 4/12 and we get $1,000. How is sales tax amount determined when the cash register total includes the sales taxes? So what's the formula that we talked about? So we want to know the sales tax amount. The first thing we do is divide the total cash register receipts by 1 plus the sales tax percentage, or 100% times the sales tax percentage. That result is our sales revenue amount. Once we have the sales revenue amount and we know the total, we can subtract that sales revenue amount from the total cash register receipts to determine the sales taxes. If $15,000 is collected in advance on November 1st for 3 months' rent, what amount of rent revenue should be recognized by December 31st? So we have 15,000 for 3 months. At December 31st, 2 months have passed, November and December. So we have 2/3 of the 15,000 we're going to recognize as rent revenue. As a bonus question, what is left in our unearned revenue account? And that's $5,000. So 1/3 of 15,000, or the 15,000 minus the 10 that we recognize. We have 5,000 left in the unearned revenue account. Payroll and payroll taxes payable. Companies are required to withhold amounts from employee wages to pay various government authorities. Companies withhold from employee paychecks amounts that must be paid to other parties. The liabilities incurred at that time. Employers also incur a second type of payroll-related liability, payroll taxes. So the employer also has to pay FICA, so the Social Security and Medicare that is withheld from employees' pay. Employer also pays that amount. And then the employer also pays state and federal unemployment taxes. Okay. So it's payday. What you earn is your gross pay. So if you earn an hourly wage of $20 an hour and you work 5 hours, your gross pay is going to be the $20 times 5, $100. Your net pay, the amount you receive in your check, is most likely going to be less than that. Why is that? It's because you have payroll deductions. So the middle three is what we're going to focus on. So you have FICA taxes, which is the Medicare and Social Security, federal income tax withheld, and state and sometimes city income taxes is withheld as well. Some other things that could be withheld from your paycheck. On the left there, insurance. So paying health insurance, you can do that with payroll deductions. Pension or 401k deductions, and union dues is another example of things that could be withheld. Those aren't taxes, those are more you're choosing to withhold those, and that sometimes also companies allow you to donate to charities through payroll deductions. So it's an easy way to donate to a charity if your employer allows that. So that could be a deduction as well. Assume Cargo Corporation records its payroll for the week of March 7th as follows. We're going to debit salaries and wage expense for $100,000. We're going to credit FICA taxes payable, federal income taxes payable, state income taxes payable, and salaries and wages payable. So that's our entry for recording the payroll. The $67,564 salaries and wages payable is what's going to get paid to the employees. That's their gross pay of $100,000 less all of these liabilities that the company has that is withheld from the employee's pay. And now we're going to record the payment of the payroll on March 7th. What we do there is debit that salaries and wages payable is $67,564 and credit cash for that amount. So we're paying that to our employees. We will pay the other taxes payable at some time in the future to the appropriate government bodies. Now, based on that $100,000 payroll, the company will record the employer's expense and liability as follows. We're going to debit payroll tax expense. We're going to credit FICA taxes payable, and then we have federal unemployment taxes payable and state unemployment taxes payable. So we record those as well. Note, the FICA taxes payable, $7,650, is the same amount that we saw here that was withheld from the employee's paycheck. That's because for FICA taxes, the employee pays half and the employer pays half. So that's going to be the same amount for each of these entries. Now, employer payroll taxes do not include which of these items? Federal unemployment taxes, state unemployment taxes, federal income taxes, or FICA taxes? And the answer is C, federal income taxes. So when recording payroll, the employer does not record federal income taxes. That doesn't mean they don't owe federal income taxes. It's just that it's not part of the payroll, whereas from an employee, they're going to withhold an amount for the employee's federal income taxes. Let's look at our fraud example. Art was a custodial supervisor for a large school district. The district was supposed to employ between 35 and 40 regular custodians, as well as 3 or 4 substitute custodians to fill in when regular custodians were absent. Instead, Art hired 77 substitutes. But in fact, almost none of these people worked for the district. Instead, Art submitted time cards, collected their checks, personally distributed the checks to the employees. If a substitute's check was for $1,200, that person would cash the check, keep $200, and pay Art $1,000. With this fraud, they took $150,000 from the school district. What were the missing controls? Human resource controls. They should have done background checks. No employee should begin work until they have been approved by the Board of Education and entered into the payroll system. No employee should be entered into the payroll system until they've been approved by a supervisor. All pay checks should be distributed directly to employees at the official school locations or direct deposited into approved bank accounts. Okay. The other one was independent internal verification. Budgets should be reviewed monthly to identify situations where actual costs significantly exceed budget amounts. So if they were seeing that they had a lot more than the 35 to 40 for substitute, or 3 to 4 substitutes on the 35 to 40 regular, they would have seen that there was a lot more being paid out for substitutes than what is necessary. During the month of September, Lake Corporation's employees earned wages of $60,000. Withholdings related to these wages were $4,590 for FICA, $6,500 for federal income tax, $2,000 for state income tax. Costs incurred for unemployment taxes were $90 for federal and $150 for state. We're going to prepare the September journal entries for salaries and wages expense, salaries and wages payable, assuming that all September wages will be paid in October, and then second, company's payroll tax expense. So what is going to be the entry to record our salaries and wages expense? We're going to debit that salaries and wages expense for the $60,000, credit FICA taxes payable, federal income taxes payable, state income taxes payable based on the information that was given. The difference is going to go to salaries and wages payable, $46,910. Okay, so there's the entry, and we got the information back from this data here. $60,000 is our salaries and wages expense. $4,590 is for FICA, $6,500 federal income tax, $2,000 state income tax. And then we need to calculate the salaries and wages payable as the difference between those. Next, what is the entry that the company records to record their payroll tax expense? We debit payroll tax expense. We're going to credit 3 liability accounts: FICA taxes payable, federal unemployment taxes payable, state unemployment taxes payable. Again, the FICA taxes payable is the same as what we had in the salaries and wages expense entry. And then they gave us back here the unemployment taxes for federal and state. So notice they only gave us once what the FICA amount was, but we used that same amount, that same data in two different entries. Now we'll talk about the major characteristics of bonds. Long-term liabilities are obligations that are expected to be paid in more than 1 year in the future. Bonds are a form of interest-bearing notes payable. They're sold in small denominations, usually $1,000 or multiples of $1,000. They attract many investors. The corporation issuing the bonds is borrowing the money. The person who buys the bonds, the bondholder, is lending the money. Okay, so it's a way that corporations can borrow money from a lot of people. So and they're not just going to a bank. It's usually investors that are buying these bonds. There are different kinds of bonds. First, we'll look at the difference between secured bonds and unsecured bonds. A secured bond is secured by the assets of the corporation. So they're going to pledge a building or a piece of equipment, potentially inventory, something that the corporation owns. So what that means is if they're unable to pay the bond when it's due, the bondholders can force the sale of that asset and use that money from that sale to pay off the bonds. An unsecured bond is simply there's no asset as collateral. You're just using the creditworthiness of the company as kind of what is backing the bond. So if it's a big company, well-known, good financials, it's going to be an unsecured bond is more likely that it's going to get paid off versus someone that doesn't have good financials. Then there's convertible bonds where you can convert the bond into stock. So instead of getting the cash payment, you can take the value of that cash payment you would get in stock. So if you think a company's stock is going to go up, you may want to do that and hold on to it. And then there's callable bonds. That's where the company can redeem the bonds early. So they call them early before the maturity date. Now, the bonds can have to be either secured or unsecured, but they don't have to be convertible or callable. And secured bonds could be convertible, they could be callable, and unsecured bonds could be convertible or could be callable. So they're not mutually exclusive, except for the secured and unsecured. Covenant light debt. Many corporation loans and bond issuances, the lending agreement specifies debt covenants. Typically are specific financial measures such as minimum levels of retained earnings, the amount of cash flows times interest earned, other measures that the company must maintain during the life of the loan. If the company violates one of these covenants, it is considered to have violated the loan agreement. The creditors can then demand immediate repayment, or they can renegotiate the loan's terms. Covenants protect lenders because they enable lenders to step in and try and get their money back before a borrower gets too deep into trouble. During the 1990s, most traditional loans specified between 3 to 6 covenants or triggers. In subsequent years, however, there was lots of cash available. Lenders began reducing or completely eliminating covenants from loan agreements in order to be more competitive with other lenders. Then when the economy declined, these lenders lost big money when companies defaulted. Recently, problems with covenant light debt have arisen in the so-called private debt market. This is where specialist funds loan money to small companies without any participation from traditional banks. So how do debt covenants provide protection for creditors? They specify particular financial measures that a company must maintain during the life of the loan. If the company fails to meet these, the creditor can demand immediate repayment before the company's financial troubles are extreme. Back to bonds. How do we issue bonds? First is authorization. So state laws grant corporations the power to issue bonds. The board of directors and stockholders usually must approve the bond issues. The board of directors must stipulate the number of bonds to be authorized, the total face value, and the contractual interest rate. Bond terms set forth in legal document known as a bond indenture. And a bond certificate, typically a $1,000 face value. The terms, so this represents a promise to pay a sum of money at the designated maturity date, a periodic interest at a contractual or stated rate on the maturity amount, which is the face value, interest payments usually made semi-annually or annually, the issued to obtain large amounts of long-term capital, so they're typically long number of years, 5, 10, 15, 20 years. The investment company sells the bonds for the issuing company. Here's an example of a bond certificate. So it's got the who issued the bond. It's got the face value, $5,000 here. It's also up here in a numerical form. It's got the contractual interest rate right here. So it's 5.75%. And this is a sinking fund debenture due May 1st, 2028. So the May 1st, 2028 is the maturity date. So those are the terms of this bond. Bondholders can sell their bonds on national exchanges. The bond prices are quoted as a percentage of the face value. So a $1,000 face value bond with a quoted price of 97 means 97% of face value. So here's a example, and this is a little bit old because Twitter is now X, but Twitter had bonds that were at paying 3.875% interest. They matured on December 15th at 2027. At the close of the trading day, it was 97.71 was the price. So it's 3.875%, $1,000 bonds that mature in 2027. They currently yield 4.06% return. That's what this yield means. At the close of trading, the price was 97.71% of face value, or $977.10. So you could pay $977.10 with a promise to get paid $1,000 on December 15th, 2027, plus interest between the date you buy that and the maturity date at 3.875% annually. Time value of money. So $1 million in 2027 does not equal $1 million in 2047. So it's the same dollar amount at different times are not equal. So we're going to look at how we determine the market price of a bond using the time value of money. So Acropolis Company on January 1st, 2027 issues $100,000 of 9% bonds due in 5 years, interest payable annually at year end. The purchaser of the bonds would receive the following two types of cash payments. One, the principal, the face value, $100,000 to be paid at maturity, and 5 $9,000 interest payments. So it's $100,000 times 9% times 1 year because of the annual interest payments. So $9,000 paid 5 times over the term of the bond. So the 9,000, the 9,000, the 9,000, the 9,000, the 9,000 in year 5 plus the $100,000 principal. So the current market price, which is the present value, is a function of 3 factors: the dollar amounts to be received, the length of time until the amounts are received, and the market rate of interest. The market interest rate is the rate investors demand for loaning funds. Okay, so if it's a similar risk loan, they're going to have the same interest rate that the market demands. May not be the stated rate of the bond. So the current market price of a bond is equal to the present value of all the future cash payments promised by the bond. So the example that we looked at, the present value of $100,000 received in 5 years is $64,993. The present value of $9,000 received annually for 5 years is $35,007. If we add those together, the market price of the bond should be $100,000, which is the face value. Okay. So there's present value tables that you can use to look up present value of $1 in 5 years. That rate is 0.64993. So that's how we got the 64,993. And then the present value of an annuity for 5 years, which is annual payments, is 3.88965. Multiply that by the 9,000, we get 35,007. Okay, so if you take a finance class, you can figure out how to calculate some of these rates. For this class, you're going to be given it, or you're going to be given what the present value is, so you don't have to worry about how that is calculated. Just know that there are tables that already calculate this for $1, and you can look up those tables and apply it to the dollar amounts in your situation to get the present value. Ford Motor Company. U.S.-based auto manufacturers accumulated debt along the way to becoming giants. During COVID-19 pandemic, these companies faced pressure to meet the obligations when their factories shut down. Some companies reported their largest ever quarterly losses. Even prior to the pandemic, auto manufacturers required more cash due to the rising costs of new technologies for electric vehicles. Fortunately, the manufacturers and their suppliers were able to raise $21.7 billion in extra long-term debt, which increased the total auto industry debt to over $1.1 trillion. There's a chart on the next page that we can look at to see that. Ford Motor Company issued 3 series of high-yield unsecured bonds, raising a total of $8 billion. Analysts suggest that this inflow of cash offered Ford breathing room until the plants reopened. However, more cash now means more debt later. Highly leveraged companies, that is, those with high debt levels, need to rely on best-case scenarios for sales. In the auto industry, there is a simple rule of thumb. New products drive products, and Ford has several new product launches planned. Investors will need to monitor both sales and any future idle factories as they consider their investments in the auto industry. So Ford did have some new products, although they just announced that they're probably going to cancel their F-150 electric vehicle because the sales aren't as strong as they thought it was, and it's very expensive to make. So, some of their new products don't always drive the new product, drive profits, although refreshing some things will help that. So here's the chart, which shows from 2010 to 2020 what the amount of debt, the total auto industry debt was. So it's automakers and suppliers. So it was just over $0.6 trillion, and then in 2020 it grew to over $1.1 trillion. Ford recently issued unsecured bonds. What is the difference between a secured and unsecured bond? So secured bonds have specific assets the issuer pledges collateral. Unsecured bonds are issued against the general credit of the borrower. Next, we'll look at some statements and determine if they're true or false. The ones that are false, we'll look at on the next slide and how to correct them. So mortgage bonds and sinking fund bonds are both examples of secured bonds. This is true. We didn't specifically talk about it in this presentation of what sinking bond funds are, but they are secured bonds, and mortgage bonds typically are secured by buildings or real estate. Unsecured bonds are also known as debenture bonds. That is true. So that's another way you can refer to unsecured bonds as debenture bonds. The contractual interest rate is the rate investors demand for loaning funds. That is false. Okay, we'll look at how to correct that in the next slide. The face value is the amount of principal the issuing company must pay at the maturity date. That is true. That's the face value of the bond is what must be repaid, not counting the interest at maturity date. And the market price of a bond is equal to its face value. That is false. Can be, but not always. Okay, now we'll look at the two statements that were false and determine how to correct them. So the first one, the contractual interest rate is the rate investors demand for loaning funds. That was false. The contractual interest rate is used to determine the amount of cash interest the borrower pays. So that's the stated rate on the bond. Stated rate, contractual rate's the same thing. That is used to calculate the interest that is paid. Okay. The market price of a bond is equal to its face value. That is false. I said it can be sometimes, but not always. So the market price is the value at which it should sell in the marketplace. The market price of the bond and its face value are often different. Now that we have some terminology on bonds and understand it a little bit, we'll explain how we account for them. So a corporation records bond transactions when it issues or sells, when it redeems or buys back the bonds, and when the bondholders convert bonds into common stock. Okay. If bondholders sell their bond investments to other investors, so if I would have bought Ford Motor Company bonds and decide at some point to sell them to somebody else, that's what we're talking about there. The issuing company receives no further cash on the transaction, nor does the issuing company journalize the transaction. Okay, the only thing they would have to do is to keep track of who owns the bond. So if it gets sold in the marketplace, they need to keep track of who owns it, because at maturity they need to know who to pay the principal back to. So we'll look at an example. January 1st, 2027, Candlestick issued its $100,000 5-year 10% bonds at 100% of face value. So we say we issued them at face value. The entry, simply debit cash 100,000, credit bonds payable 100,000. Okay. Now let's look at what happens on December 31st. So we're going to assume that interest is payable annually at January 1st. So at December 31st, we're going to recognize interest expense. We assume monthly accruals have not been made. So we debit interest expense 10,000, credit interest payable 10,000. Same entry we did when we looked at notes payable and we accrued interest. And how we calculate interest is the same way as well. Interest is equal to the face value times the interest rate times time in terms of a year. So in this case, $10,000 times 10% times 1 year. Now we're going to look at January 1st, 2028, and we're going to pay that first year interest. Since we already accrued it and set up the liability, we're going to relieve that liability, debit interest payable, credit cash for that $10,000. Now what happens if a bond does not sell at its face value? We say that it's either a discount or a premium. So the contractual or stated interest rate and the market interest rate often differ. Remember, the market interest rate is what investors demand as part of as an interest payment. To make bonds saleable, when the two rates differ, bonds sell below or above face value. When a bond is sold for less than its face value, the difference between its face value and selling price is called the discount. When the bond is sold for more than its face value, the difference is called a premium. So if it's below face value, it's a discount. Above face value, it's a premium. Let's look at that graphically. So if a bond's contractual or stated interest rate is 10%, if the market interest rate is 10%, the bond sells at face value. So what that means is that what the company is paying, what this bond is paying, is what the investors are demanding. So they're going to pay the face value for it. If the market interest rate is lower than what we're paying, so it's 8% instead of 10%, the bonds are going to sell at a premium. So that means our investors are willing to pay a little bit more to get that 10% interest because other investments are only paying 8%. If the market interest rate is higher at 12%, that means investors can go out and get a 12% return on similar investments. We're only paying 10%, so they're not going to pay the full face value. They're going to pay less than that, so the bond is going to sell at a discount. The rate of interest investors demand for loaning funds to a corporation is the contractual interest rate, the face value rate, the market interest rate, or the stated interest rate. The answer is the market interest rate. That's what investors are going to demand. Issue bonds at a discount. So the candlestick example, $100,000 face value, 5-year 10% bonds, sell for $98,000, 98% of face value, interest payable annually on January 1st. We'll record that issuance. Remember, when we sold it at face value, we debited cash for $100,000, credited bonds payable for $100,000. In this case, we're only going to receive $98,000, so we debit cash $98,000. We debit this new account discount on bonds payable for $2,000. We record the liability at face value, $100,000, because in 5 years, that's what we have to pay the bondholders. We have to pay the full $100,000, even though we only received $98,000. So the discount on bonds payable, it's a contra account, increases with the debit, has a normal debit balance, and it decreases with the credit. So at issuance, if we did a balance sheet, we would show under long-term liabilities the bonds payable, $100,000, that's the face value, less the discount on bonds payable of $2,000, so $98,000 net. So that's why that's the contra account, so it decreases the face value. So again, issuing the bonds below face value is a discount. Our total cost of borrowing is going to be more than our interest paid. So the borrower is required to pay the bond discount at the maturity date. Therefore, the bond discount is considered to be an additional cost of borrowing. The company records this additional cost as interest expense over the life of the bond. How do we calculate the total cost of borrowing? There's 2 ways we can do it. We can take the $100,000 times 10% is our $10,000 annual interest times 5 years, so $50,000 in interest payment, plus the $2,000 bond discount, so we have to pay that back, so $52,000 is our total cost of borrowing. The other way to think about it is we're going to pay $100,000 at maturity. We're going to pay $50,000 in interest over the life of the bond, so we're going to pay $150,000 to the bondholders. We only got $98,000. That's what we received when we sold the bonds. So the difference is the $52,000 cost of borrowing. If we sold it at face value, the cost of borrowing would just be the interest payments. We amortize the bond discount over the life. So our carrying value, which is the face value minus the discount, is going to go from $98,000 up to $100,000 over the 5 years. We don't show and we don't talk about how we do that amortization in this class, but just know that it happens. So over time, the carrying value is going to increase. Our discount is going to decrease. Okay, so that's the important thing to know. If you take another advanced accounting class or a finance class, you'll see how that actually happens. A review question: discount on bonds payable is, or has, a credit balance, is a contra account, is added to bonds payable on the balance sheet, increases over the term of the bonds. The only true statement is that it's a contra account. It's actually all the others, you have to reverse that to make them true. It has a debit balance, it's subtracted to bonds payable on the balance sheet, and it decreases over the term of the bonds. Premium. Bonds sell at a premium, so we're going to receive more than the face value. On the statement, we have a premium on bonds payable. Again, it's a contra account, but in this case, it adds to bonds payable to get our carrying costs, $102,000. Our total cost of borrowing is less than interest paid. Okay. The reason is the borrower is not required to pay the bond premium at the maturity date of the bond. Therefore, the bond premium is considered to be a reduction in the cost of borrowing. So we sell the $100,000 5-year 10% bonds for $102,000, 102% of face value. Interest payable annual on January 1st. The issuance is debit cash, $102,000. That's the cash we received. We're going to credit bonds payable for the face value. Bonds payable is always recorded at face value, $100,000. And then we credit this new account premium on bonds payable for $2,000. Premium on bonds payable has a normal credit balance, increases with credit, decreases with the debit. To calculate our total cost of borrowing, similar to when we had a discount, we take the annual interest payments, $50,000, but we subtract the bond premium of $2,000 to get $48,000. Or we can look at the cash flows. We're going to pay $100,000 at maturity. We're going to pay $50,000 in interest payments. So we're going to pay $150,000 total. That's the same in both of our examples, a discount and premium. But now we subtract cash received from bondholders is more than our face value, $102,000. So our total cost of borrowing is $48,000, which is less than the annual interest payments. And again, that premium is going to increase our carrying value to $102,000 at issuance. It's going to be above our face value, but over 5 years, the carrying value is going to equal the face value. So we're amortizing that bond premium over the life. We're decreasing the bond premium over the life of the bond. Again, we don't get into the details on how we do that. You'll see that in another class, but just know that that bond premium decreases down to $100,000 carrying value at the time of maturity. So Giant Corporation issues $200,000 of bonds for $189,000. Prepare the journal entry to record the issuance of bonds and show how the bonds would be reported on the balance sheet at date of issuance. So if we sell $200,000 of bonds for $189,000, did we sell it at a premium or discount? Since we received less than the face value, we sold it at a discount. So we're going to debit cash the $189,000 that we sold it for, credit bonds payable at face value $200,000, and then we debit the discount on bonds payable, the difference, $11,000. How do we show it? On the balance sheet at the date of issuance, under long-term liabilities, we have bonds payable of $200,000. Then we subtract the discount on bonds payable of $11,000, and our carrying value, our net on the balance sheet, is $189,000. So questions about bonds issued at premium. If Carson issues 10-year bonds with a maturity value of $200,000, if the bonds are issued at a premium, this indicates which of these is true. The contractual interest rate exceeds the market interest rate. The market interest rate exceeds the contractual interest rate. The contractual interest rate and the market interest rate are the same, or there's no relationship between the two rates. So we're selling our bonds at a premium. That means the contractual interest rate exceeds the market interest rate. So investors are willing to pay a little bit more because we're paying a higher interest rate than what they can get in the market. Redeeming bonds at maturity. Assuming the company pays and records separately the interest for the last interest period, how would Candlestick record the redemption of its bond at maturity? We're going to show a reduction in bonds payable at face value of $100,000, and we're going to pay cash to the bondholders of $100,000, so we credit cash $100,000. Okay. What if we redeem bonds before maturity? So we need to eliminate the carrying value of the bonds at redemption date, record the cash paid, and then we're going to recognize either a gain or loss on redemption. Again, the carrying value is the face value less any remaining bond discount, or the face value plus any remaining bond premium at the redemption date. When bonds are redeemed before maturity, the gain or loss on redemption is the difference between the cash paid and which of these? The carrying value, the face value, the original selling price, or the maturity value of the bonds. We just saw that. It's the carrying value. So the difference between cash paid and the carrying values. So let's look at an illustration. So assume we sold the bonds at premium, the Candlestick bonds. We're going to redeem these at 103 after paying the annual interest. The carrying value of the bonds at redemption is $100,400. What's the entry we make at the end of the fourth interest period? We eliminate our liability bonds payable, the face value, so we debit bonds payable $100,000. We have a carrying value more than our face value, so we have a credit in our premium still of $400. So we're going to debit premium on bonds payable of $400. The cash paid is $103,000. So we redeemed them for a 103, so that's still the same concept as 103% of the face value. So we had to pay $103,000 to redeem these bonds early, which leaves us with a loss on bond redemption of $2,600. That's the difference between the cash paid, $103,000, and the carrying value, $100,400. So again, here's that showing that the carrying value is being reduced down to the face value. At the end of year 4, it's $100,400. Again, we're not looking at how that math works to get us there. We're just given that amount and can do the journal entries based on that. So R&B Inc. issued 500,000 10-year bonds at a discount. Prior to maturity, when the carrying value of the bonds is $496,000, the company redeems the bonds at $98,000. Prepare the entry to record the redemption of the bonds. Okay, so looking at this information, $500,000 face value, so that's what's in our bonds payable account. So if we're going to redeem these, we're going to debit the bonds payable for $500,000. Since our carrying value is less than that, that means we sold them at a discount. We still have some discount left, in this case $4,000 left in discount. Remember, discount has a debit balance, so we're going to credit the bond discount for $4,000. We're going to credit cash. How much cash are we going to credit? How am I going to pay out? If we redeem the bonds at 98, we're going to redeem them and pay 98% of the face value. So it's going to be less than the face value, so it is $490,000. And then finally, the difference between the carrying value, $496, and our cash paid, $490, is either a gain or a loss. In this case, it's a gain because we're paying less than the carrying value. So we credit gain on bond redemption of $6,000. Now we'll look at how to account for long-term notes payable. So long-term notes payable may be secured by a mortgage that pledges title to specific assets as security for a loan. Mortgage typically is on real estate. Typically, the terms require the borrower to make installment payments over the term of the loan. Each payment is going to consist of interest on the unpaid balance of the loan and a reduction of loan principal. Companies initially record mortgage notes payable at face value, but different from bonds payable and notes payable, when we pay off, when we make a payment, we're going to reduce some of that principal, and we do that by reducing the mortgage bond payable. So here's an example of $500,000, 8% 20-year mortgage note on December 31st, 2027. The terms provide for annual installment payments of $50,926, which doesn't include real estate taxes and insurance. So at the issue date, we have a balance in the principal amount of $500,000. We make the first payment of $50,926. So we state how much the payments are each year, and it's going to be the same each year, but we're going to split that payment between interest expense and principal reduction. How we calculate these is we calculate the interest expense first. That's the interest rate times the principal balance. So in this first case, it's $500,000 times 8%. So $40,000 of that first payment is going to be to interest. The remaining is going to reduce our principal, $10,926. So then we take the $500,000 minus that $10,926, and our new principal balance is $489,074. The next year, when we make that $50,926 payment, only $39,126 is going to go to interest because it's a lower balance in the principal times the same interest rate, 8%. We get a lower amount there. More is going to go towards the reduction of principal, and we have a new principal balance, and that continues. Now, what are the interests to record the mortgage in the first payment? So to record the mortgage, it's like we've seen before, we're receiving cash. We're going to debit cash for $500,000, credit mortgage payable for $500,000. But when we make the first payment, the $50,926, we're going to split that between interest expense, that $40,000 we calculated in that first payment, and then the mortgage payable. So we're reducing that mortgage payable account directly, $10,926, and the cash we paid is the $50,926. So that's the entries at issuance, and then 1 year later when we make the first payment. So a review question. Each payment on a mortgage note payable consists of A, interest on the original balance of the loan, B, reduction of loan principal only, C, interest on the original balance of the loan and reduction of loan principal, or D, interest on the unpaid balance of the loan and reduction of loan principal. And the answer is D, interest on the unpaid balance of the loan and reduction of loan principal. Lease liabilities. We talked about this a little bit when we talked about plan assets. A lease is a contractual agreement between a lessor, the owner of the property, and a leasee, the renter of the property. The arrangement gives the leasee the right to use a specific property for a specified period of time. The leasee makes rental payments over the lease term to the lessor. For all leases greater than 1 year, the leasee records a right of use asset and a lease liability. Since it's greater than 1 year, it becomes a long-term liability. So let's look at long-term notes. So another mortgage example. Cole Research issues $250,000 6% 20-year mortgage note to obtain needed financing for a new lab. The terms called for annual payments of $21,796 each. Prepare the interest to record the mortgage loan in the first payment. So to record the mortgage, we're going to debit cash $250,000, credit mortgage payable for $250,000. We make the first payment. We're going to credit cash that payment amount, $21,796. The debits are split between interest expense and mortgage payable, the principal reduction. Interest expense is the balance of the loan. In this case, the face value $250,000 times 6% is our 15%. And then we subtract that from the total payment to get how much the principal is reduced, and we debit mortgage payable for that amount. If we were to do the second payment, the cash credit would be the same. We would use the same accounts, interest expense and mortgage payable, but the interest expense would now be the $250,000 minus this first principal reduction. So 243 something. I didn't do the math, so I don't have that. But that balance times 6% would be the interest expense for the second payment. Now let's look at how liabilities are reported and analyzed. On the balance sheet, we have two categories of liabilities. We have current liabilities, that's the first category. Companies list each of the principal types of current liabilities separately within that category. So we talked about accounts payable, sales tax payable, salaries and wages payable, current portions of long-term debt, so those types of things. Long-term liabilities are reported separately immediately following current liabilities. Summary data regarding debts may be presented in the balance sheet with detailed data shown in supporting schedules in the notes. So here's an example. We have notes payable, we have accounts payable, current maturities of long-term debt, accrued liabilities. So this could be a number of things, so there's probably a schedule that shows that. Total current liabilities, and then we have our long-term liabilities, bonds payable less the discount, notes payable, saying it's secured by plan assets, so they're secured notes, and then we have lease liabilities. Total long-term liabilities, we add up the total current, total long-term to get total liabilities. So here's an example of General Motors balance sheet, very summarized. So we have total current assets, total non-current assets, total current liabilities, total non-current liabilities, total stockholders' equity, and then total liabilities and stockholders' equity. They would then, in their notes, break out each of these categories and show more detail. We'll look at some analysis. Liquidity refers to the ability to pay maturing obligations and meet unexpected needs for cash. The relationship of current assets to current liabilities is critical in analyzing liquidity. We can express this relationship two ways. One as a dollar amount, it's called working capital, and as a ratio, we call it the current ratio. So if we look at the working capital, it's the excess of current assets over current liabilities. So we take current assets minus current liabilities. In this case, we have negative working capital. So what that means is in order to pay our current liabilities, those things that are going to become due within the next year, we're going to have to raise money above our current assets, which is we expect to turn into cash within a year. So we have a mismatch there. We're going to have to come up with some financing to pay that. Again, just looking at this, we can't say if it's okay or not okay. It's typically not okay if it's negative. You want a positive working capital. But if you look at the company's history at this point in time, whenever this balance sheet was done, that may be normal, and that the next period they have some things that become cash more quickly, or the current liabilities could be fully a year out, so they have time to get it. So just seeing that, yeah, negative is not usually good, but it might be okay based on the company. The current ratio permits us to compare the liquidity of different size companies and of a single company at different times. So I think this is the General Motors data. These are billions of dollars. You know, comparing that to a smaller company, the $9 billion is going to be a lot different than $100,000. But if you use the current ratio, you can compare those ratios a little easier. Calculate the current ratio by current assets divided by current liabilities. So it's the same current assets and current liabilities. One subtracts the liabilities, the other is a division, and you get it. In this case, it's 0.88 to 1. If it was 1 to 1, then current assets would equal current liabilities. If it's working capital is negative, in this example, you're going to have a number less than 1 to 1. If working capital is positive, you'd have a number greater than 1 to 1. Solvency refers to the ability of a company to survive over a long period of time. There's two ratios that provide information about long-run solvency and the ability to meet interest payments. That's the debt to assets ratio and the times interest earned. So if we look at the General Motors, they had total liabilities of 182,080 million, so 182 billion. Total assets of 228,037 million, so $228 billion. Their debt to asset ratio is 80%, and we get that by total liabilities divided by total assets. Okay. The higher the percentage of debt to assets, the greater the risk of company may be unable to meet its maturing obligations. Okay. So a quick difference here. Current ratio was current assets divided by current liabilities. The debt to assets ratio is liabilities divided by assets. And we're talking about the totals, not just the current. So we get a percentage here. Lower percentage is better. The other way, we were getting a ratio to 1. So just keep those clear. So they're very similar the way we calculate them, but that slight difference could really mess you up if you're trying to calculate it doing the homework or on an exam. And then finally, times interest earned. It's the ability the company has to meet its interest payment as they come due. So we take net income, add back interest expense, add back income tax expense, and divide it by the interest expense. So the earnings, the net income, excluding income tax and excluding interest, is 10.5 times what the interest payment is. So they've earned 10.5 times their interest payment. So they look like they're in pretty good shape to be able to pay their interest payment. Review question. Working capital is calculated as current assets minus current liabilities, total assets minus total liabilities, long-term liabilities minus current liabilities, both B and C. That should give you a hint there. The answer is current assets minus current liabilities. Now let's look at the difference between debt and equity financing. So bond financing is debt financing. Equity financing would be issuing more stock. So if we do bond financing or debt financing, stockholder control is not affected. So the bondholders do not have voting rights. Current owners, the stockholders retain full control of the company. There's a tax savings. Bond interest is deductible for tax purposes. Dividends that you pay to the stockholders are not. The return on common stockholders' equity may be higher. So although bond interest expense reduces net income, that return on common stockholders' equity is often higher under bond financing because there's no additional shares of common stock issued. So we'll look at an illustration here. Microsystems is considering two plans for financing the construction of a new $5 million plant. Plan A involves issuing $200,000 shares of common stock at the current market price of $25 per share. Plan B involves issuing 25 million or 5 million 8% bonds at face value. Income before interest and taxes on the new plant will be $1.5 million. Income taxes are expected to be 30%. Microsystems currently has 100,000 shares of common stock outstanding. So what happens if they issue the stock? They're going to get $1.5 million income before interest and taxes. There is no interest expense. So like income tax expense would be $450,000, 30% of that 1.5 million. So net income would be $1,050,000. Our outstanding shares are going to now be 300,000. So it's the 200,000 that we're issuing plus the 100,000 that are already outstanding. So our earnings per share is $3.5. If we issued bonds, we're going to have the same income before interest and taxes. Now we're going to have $400,000 of interest expense, so 8% of the $5 million. So we're going to have lower net income or income before taxes, which means we have lower income tax expense using the same 30%. And we have lower net income, $770,000. But with only 100,000 shares outstanding instead of 300,000, our earnings per share is $7.70 per share. So if earnings per share is going to be your measure and deciding point, you would do Plan B. If net income is your only consideration, you would do Plan A. Typically, it's somewhere in between, so you're using all of this data to come up with a decision. So let's do some of these ratios. We have some information listed here for Trout Company as of December 31st, 2027. In addition, they have reported net income of $14,000, income tax expense of $2,800, and interest expense of $900. What's the current ratio in working capital for Trout? Remember, the current ratio is current assets divided by current liabilities. Working capital is current assets minus current liabilities. So our current ratio is 1.31 to 1. The 10,500 current assets divided by the 8,000 current liabilities. And our working capital is 2,500. Current assets of 10,500 minus $8,000 of current liabilities. And then what is, they issued $2,000 cash to pay off $2,000 of accounts payable. We haven't gone to the next one yet, sorry. How would the current ratio and current working capital have changed? So again, we calculate those items. The current ratio is up now to 1.42 to 1 versus the 1.3 that we saw on the previous slide. So it's 8,500 current assets to the new $6,000 of current liabilities. Our working capital stays the same at 2,500 because we reduced our current assets by 2,000 and our current liabilities by 2,000. So that difference stayed the same. Now it's 8,500 divided by 6,000, 2,500. Now we're going to compute the debt to asset ratios and the times interest earned. Debt to asset is the total liabilities, 24,000, 8,000 current, 16,000 long-term, divided by total assets, 34,700, 69.2%. And times interest earned is 19.67 times. We get that by net income, add back the income tax expense, add back the interest expense, divided by the interest expense. And that's it for Chapter 10. Please reach out if you have any questions. Have a good day.